In the first video, we also had another example, which was an option contract to sell a car. In this example, we have Cindy, who is the buyer of the option contract to sell. As the buyer, Cindy has the right to sell the underlying, which is the car, at the exercise price of $10,000, and this contract has an expiration period of 3 months. Dylan, who is the seller of the options contract, has the obligation to buy the car from Cindy if she chooses to exercise her right at the term stated in the contract. And for the right to sell the car, Cindy pays a premium, and for the obligation to sell the car, Dylan collects the premium. In the equity markets, options contracts to sell underlying shares are known as put options. Today we're going to talk about what are put options. A put option is a contract to sell 100 shares of the underlying stock. The buyer of the put option pays a premium and has the right, but not the obligation, to sell 100 shares of the underlying stock at the exercise price by the expiration date. The seller of the put option is paid the premium for the obligation if the buyer exercises his right, and the seller would have to buy 100 shares of underlying stock from the buyer of the put option at the exercise price by the expiration date. Let's take a look at this from an illustration. The current price of Clip is $100. Now Cindy believes that the share price of Clip is going to decrease. So what can Cindy do about her prediction? Cindy can short sell the underlying shares in Clip. Just to give a quick overview of what short selling is, short selling essentially is selling something first at a higher price with the intention to buy it back again when the price falls lower later. In order to short sell Clip, Cindy would have to borrow 100 shares of Clip and sell them in the market at today's price. And for this, she will collect $100 per share for 100 shares, and that will be a total receipt of $10,000. Alternatively, Cindy can buy a put option in Clip, which would give her the right, but not the obligation, to sell 100 shares of Clip at the exercise price of $100 by the expiration date of, let's say, 1 year. And for this option, she pays a premium of $10, which is a total amount of $1,000. So let's take a look at what could happen a year from now. In the first scenario, Cindy's prediction has played out well, and the market price of the underlying Clip is now at $50. If Cindy had opened a short position on the underlying, she would have sold 100 shares of Clip at $100 per share, and today she can buy back the shares at $50 per share, and that would give her a profit of $5,000. On her initial capital of $10,000, this would be a return of 50%. However, this is only a theoretical scenario, as short selling often involves a variety of other costs and commissions, which we will not be covering in this theoretical example. What happens if Cindy had bought the put option instead? As the market price of the underlying today is at $50, Cindy can exercise her right to sell the shares at $100. Effectively, it means that Cindy can go to the market and buy 100 shares of Clip at the current market price of $50 and then exercise her option contract to sell them for $100 per share to the seller of the put option. And that would give her a profit of $5,000. And then we deduct the cost of the put option, which was $1,000, and this effectively will give Cindy a profit of $4,000. Her initial capital was the $1,000 that she paid for the put option, and this would give her a 400% return on her capital. Using a put option as compared to short selling the underlying can lead to a much higher return on capital. But what happens if Cindy is wrong and the price moves in the opposite direction? In our second scenario, the share price of Clip has increased to $150 instead. If Cindy had opened a short selling position in the underlying, she would have sold 100 shares in Clip at $100 per share. Today, in order to close her position, she would have to go into the market to buy back her shares at $150 per share. This would give her a loss of $5,000. And on the initial capital of $10,000, this would amount to a 50% loss. However, if Cindy had instead bought the put option, when the market price of the underlying is above the strike price of the put option, Cindy will not exercise her right to sell the shares. So her loss will be capped at the $1,000 that she paid for the put option. Since her capital outlay was the $1,000 paid for the put option, this would amount to a 100% loss. Buying the put option instead of short selling the underlying can help to cap losses in the event that the trade does not play out as planned. So put options are contracts between two parties, the buyer of the put option and the seller of the put option. Let's take a look at how these outcomes affect the seller of the put option. The seller of this put option is Dylan. By selling the put option, Dylan has the obligation, if Cindy chooses to exercise the right, to buy from Cindy 100 shares of the underlying stock at the exercise price of $100 per share by the expiration date of, in this case, 1 year. And for this option contract, Dylan is paid a premium of $1,000. In our first scenario, Cindy was right about her prediction and the price of the Clip falls to $50. Therefore, Cindy will exercise her right, and as a seller of the put option, Dylan must buy 100 shares of Clip from Cindy at the exercise price of $100. Because the market price of the shares is $50, the market value of Dylan's investment would be at an unrealized loss of $5,000. However, since Dylan receives the $1,000 for selling the put option, his total loss on this trade will be $4,000. In the other scenario, the share price of Clip instead has increased to $150 per share. In this case, Cindy does not exercise the right to sell the shares, and Dylan does not need to buy the shares from Cindy. So Dylan's total gain is the premium that he collected of $1,000 for selling the put option. A put option is a contract to sell 100 shares of the underlying stock. The buyer of the put option pays a premium and has the right, but not the obligation, to sell 100 shares of the underlying stock at the exercise price by the expiration date. The seller of the put option is paid a premium and therefore has the obligation, if the buyer exercises the right, to buy 100 shares of the underlying stock at the exercise price by the expiration date. In the event that the market price of the underlying falls below the strike price of the option at the expiration date, the buyer of the put option can choose to exercise the option. The seller of the put option is obligated to buy the 100 shares from the buyer. The investment return to the buyer of the put option can be significant, as the share price of the underlying can fall to zero. If the share price of the underlying falls to zero, the loss to the seller of the put option can be significant. If on the expiration date, the market price of the underlying is above the strike price of the option, the buyer of the put option will not exercise the option. Therefore, there is no action needed from the seller of the put option. The losses of the buyer will be capped at the premium paid for the option, and the gains for the seller will be capped at the premium received for the option. So what are the benefits and drawbacks of trading put options? Using put options can lead to a higher percentage returns on capital deployed. In the event the trade does not play out the way that the buyer of the option expects, losses will be capped at the premium paid. Also, there are costs associated with short selling underlying, which can be avoided by buying a put option. However, the drawbacks of buying a put option is that 100% of the capital can be lost. For the seller of the put option, the collection of premiums can be a good, regular income generation strategy. We will talk more about these income generation strategies as we go along. However, losses can also be significant as the shares of the underlying company can fall to zero. So I hope this video gives you a good overview of what put options are. If this video was helpful for you, please like the video and subscribe to the channel. If you have any comments or feedback, please leave them in the comment section below.